Greetings, Jonathan Camarda, as we head into the dog days of August, mid-August. And dog days is right, as last week we saw a little bit of changing in the theme, so to speak. So let's kind of start from the top down there, from the macro, and then we'll drill our way down into equity markets and then how it applies to strategies. So have seen a little bit of some changing winds here. And first, our heart goes out to the folks in Hawaii, as we definitely thoughts and prayers. And certainly if you have any family there, certainly prayers with you and them. So where we see markets right now, we had kind of a confluence of inflation data last week. CPI came a little under expectations at 0.2. PPI, which the actual Fed looks at a little bit more closely and monitors, came in a little bit higher than expected at 0.3. Although if you look at the PPI down from, it's down the pre-pandemic levels, versus where it was even a year ago. So down pretty significantly. Now, the CPI data, shelter costs, housing costs are still pretty high, but showing signs of coming down, and we do see those, coming down further. So again, as we start to look though, rates, the 10-year spiked again, to a level where again we have to watch that and its effect on equities, along with energies. Now, interestingly, last week inventories for energy actually rose, but so did the price of oil as well. So again, on our sector watch as well, we started participation in energy really over a month ago, but again, certainly that seems to be gaining steam. Now, as we look across the risk landscape, mortgages certainly are at risk when you start to look at banks on the commercial end, certainly where a lot of focus is at. And certainly we'll be watching there to see how things progress. Again, this was foreshadowed in the spring market due to some quantitative easing to help that out. Certainly was a buoy to the market, but certainly credit risk on the mortgage side, and especially the commercial mortgage side, certainly should be watched. And of course, we don't need to go into commercial real estate in general, as again you see a lot of languishing there, and a lot of defaults expected as rates ratchet up on some of these recalibrations of mortgages over the next several months into 2024. Now, as far as what we watch a lot, we don't always talk about it here for the sake of getting too granular. However, kind of a seminal moment. We're watching, obviously, year to date, the euro versus the dollar, right? EUR versus USD has been trending up. Again, a weakening dollar here allows a lot of our large caps, again, which have done great this year, international, multinational companies, allows them to sell more goods overseas. The weaker dollar has helped out as opposed to last year, right? That may be reversing some here, especially with some weaker economic data in Europe, and that starts to reverse. That puts a lot of pressure as well. And that makes sense in confluence with where we see the 10-year rates going, the yields going. The dollar may start to find some resilience at this point. And so the other thing that we're going to discuss as well is how that pertains obviously to equities, which is, and your fixed income markets, which is what most of you folks certainly look at. So as we now meander over to equity volatility, we've seen a pickup in volatility, right? The VIX, which was taking a nap for several weeks there, is starting to pick up. And one of the things that we watch as well is for the put-to-call ratio. Again, a quick option summary. Not to get too deep, but put-to-call ratio means the higher that is, there are more shorts on the market, short bets by institutions versus longs. So when that gets extreme, like we saw post-pandemic, and certainly last October, when it gets to close to a 1 level, 0.95 post-pandemic, actually over 1 last October, decent buying signal, right? Because then things tend to revert. Now, we've seen, obviously, that put-to-call ratio come down this year, right, because the market's been up. So think about its inverse, like a seesaw. Not into over-bullish territory, but at a 0.55 reading, we look at that, again, some mean reversion, some correction in stocks. Now, as we drill down now to equities, as I promised, right, get right to the meat of it, so to speak. The S&P and the Dow Jones hanging pretty decently, with the Dow Jones hanging around that 21-day moving average, which is pretty constructive. Makes sense, right, with industrials and energies picking up Dow Jones, which has been the laggard this year, starting to hold up a little bit better than the S&P 500, which is nesting right on that 50-day moving average. And then, of course, the star performer this year, after getting trounced last year, NASDAQ, actually broached its 50-day moving average. So we're looking at that 100-day moving average. Now, what this means within strategies is you'll start to see, again, some rebalancing and, as I like to say, resectoring as we kind of, again, move some of our large gains in certain areas to areas that have started to pick up momentum really over the last month. And you might have seen this in some of your strategies, like Velocity Raptor, in a sense, for clients there, that, again, energies and as such were picked up, not in the highest percentage, but participation last month. And again, you'll start to see that continually flow through your global macros and as such as well, and then possibly into, again, more of your slower moving opportunistic growth and income, the blue chip strategy. So as we look across the landscape, fixed income right now getting tested, right? As rates go up, obviously that's pressure on fixed income. So we do like treasuries, we do like good corporate, corporate yields as well. Now, high yield bonds, again, do well when markets are flourishing. They're more higher risk. However, again, if credit becomes an issue, which it is not, right? As I say, the credit spread has remained tight, which means that, again, that's a risk-on environment. When that starts to, again, get a larger spread, and that's the spread between, again, more risky corporate bonds and your treasuries, okay, to make it very simple. When that spread widens, again, that's more of a risk-off environment, right? That means that you have to get a lot higher yield for riskier bonds than you will for a safer bond. When things are good, it's tighter. Because things are good, less defaults, those more risky corporate payers don't have to pay you as much because it's sunny outside, metaphorically speaking. So hopefully that makes sense. So again, the mood has changed a little bit, not to be unexpected though. In mid-August through September and October, do you throw the baby out with the bathwater? Certainly not, as the market continues to see it be in an up phase. But more tactical strategies, especially in your tax-deferred accounts. Again, talk to your personal wealth advisor within your sleeving there and how it applies to you. There will be more tactical moves made with the uptrend in place. Now, to give you a little perspective, as things get a little rocky, going back the last several decades, the average return from August 11th to December 31st is about 3.6 or 4%, the average rate of return. So not as attractive as the early part of the year, but a decent little mid-single digit gain there. And the worst drawdown average of the drawdowns over that same period of time from August 11th to December 31st is about 9.2, 9.3 on the worst of it. Of course, you've had outliers like we saw in 2018 and as such, but for the most part, stays within those high single digits to the downside. So again, depending on risk appetites and strategies, we look at that from a risk management standpoint. So I've probably given a little too much of the linear stuff today, but did want to really kind of get a little serious here as we're trying to cut through the tough part of the steak here on the dog days. Low volumes, but that doesn't mean low volatility. Low volume still can be high volatility. And certainly we're gauging that. So as football kicks off, some of the whirlwinds do as well. Watching some big name earnings. Won't get into names as I did last week, but as we move through the next week or two as well, and those could be bellwethers. I'll give you a hint though. Some of your clients, obviously, the more aggressive strategies are up big in one of the stocks coming up here in the next 10 days, and that could be a bellwether as well, depending on earnings. How they project things going forward in the AI space. Probably know which name I'm talking about. Without further ado, until next time, Jonathan Camarda. Stay frosty. It's hot out there. Godspeed to loved ones and everyone out in the beautiful islands of Hawaii. And stay frosty. We'll stay vigilant. Talk to you next time.